In our previous sessions, we have learned some of the basic terminologies of accounts and learned all the accounting principles. Today, we will go through some very important practices that are essential to follow in order to gain loyalty and to portray a true picture of your business to stakeholders who are very important for the business. These practices are a custom or a way of doing things that is widely accepted and followed, and this is why they are termed as accounting conventions. My friend Peter has read about these conventions, but he wanted a clear picture of what each of them really meant. So let's try to understand each of these conventions. There are 4 conventions in total. The first one is materiality. The word material in legal terms means relevant and significant. Some financial information might be material or relevant to one company, but it might be irrelevant or immaterial to another. This is somewhat obvious when you think about a small company versus a large one. Let's assume there is a company with an annual profit of $1 million. If they misplace some goods from their office worth $2,000, this would be an immaterial thing for such a $1 million company. It would not significantly affect the decisions of different users of the reports or stakeholders. Such losses can be ignored or clubbed together with other expenses in their accounting reports. However, if goods worth $2,000 is misplaced for a company whose annual profit is only $20,000, for them this is a material loss as it is 10% of their profit. Such information could sway the opinion of a financial statement user. Therefore, they would have to account for this loss separately and clearly show this on their reports so that the users can make proper judgment of the company's status. Another example, let's assume my friend Peter's income is approximately $50,000 annually. Okay, so if he spends $6,000 on his rent, it is a huge expense for him, right? But if he spends only $50 on stationery for the entire year, is this a material expense for his business? No. So he could club the expense under general expenses or miscellaneous expenses with other small expenses. The company generally decides what % of their income would they consider to be immaterial, and it is generally around 1%. This was the convention of materiality. Let's move on to the second convention, consistency. Suppose we go to a doctor and she prescribes us a medicine, say for a period of 10 days. We have to be consistent in taking the medication in order to see results and to be able to compare our health to that of the previous day. But if we keep changing our medication very often, or if we just skip them altogether, we will not be able to see the kind of results that were expected. The doctor will prescribe or allow us to take another medication only if there's a genuine reason like an allergy or a side effect. What is important here is being consistent. In the same way, in accountancy, we must maintain a uniform accounting practice. Otherwise, we would not be able to compare the progress of our company with our previous reports. Our reports may not show a true and fair picture of our profits or losses. If at all we are changing any method, the reason for it must be disclosed as a footnote so that users are aware of the changes that are affecting the amounts on these reports. Let's put it this way. To calculate valuation of stock or depreciation, there are many methods that we can use in accountancy. So if we choose one particular method in one accounting period, the same should be consistent in future accounting periods as well. Changes in method are permitted only when the new method follows gives a clear and better picture of the business activities. and also its effect must be disclosed in the financial statements clearly. There are different rules in different countries regarding this permission of change in method or policies. Moving on to the third convention, conservatism. Do you remember a time when you expected low marks in an exam or expected something to go wrong? You would inform people of concern well in advance so that they do not have high expectations from you. But on the same hand, if you were very sure to get through an interview or score exceptionally well in an exam, you would not go around announcing it until the news was confirmed. The convention of conservatism is similar to this scenario. In a business, oftentimes there's a situation where in future you may or may not incur a particular loss. For example, let's say Peter has given some goods on credit to his neighbor for $500. But his neighbor has suffered huge losses and he needs to even vacate his house. Peter is well aware of his financial condition, and so he kind of suspects that the money the neighbor owes him of $500 might not be returned in future. This is called as a doubtful debt. Such kind of losses may or may not arise in future. However, Peter will have to provide for such losses in advance to play a safe game and to be prepared for these kinds of losses if they happen to arise in future. On the other hand, expected incomes or profits are never shown on reports until they arise, until they are confirmed. The business does not want to keep its stakeholders in high hopes and then let them make wrong decisions if at all these incomes or profits do not arise. It'll be like cheating them by wrongly reporting things on their reports that have not happened. So, conservatism should be applied cautiously or prudently, such that the statements do not get distorted. In a way, conservatism calls for the accountant to present the worst-case scenario in the financial statements. This was the convention of conservatism. All okay so far? Let's proceed to the last convention, that is convention of full disclosure. The convention of full disclosure states that you should correctly and clearly disclose all important matters in financial statement reports that would affect a reader's understanding of those statements. You might be wondering what kind of disclosures. Now, actually, this convention is where all the other conventions that we just studied come into the picture. We should disclose if there is any change in the method or policy that we use for calculating or valuation purpose, which might sway the opinion of the user. We learn this in consistency. We should also disclose all relevant material information, convention of materiality. We should disclose all expected, probable, or possible losses and provide for them well in advance. This is the convention of conservatism. It may also include a case filed in the court or a dispute with government entity over a tax position, any important non-monetary transaction, a relation with a company with whom there is a significant transaction volume, anything which cannot be included in the accounting reports but are of great value to the users of these reports. And where is this disclosure made? There is a separate section called as Notes to Accounts or Disclosures below the financial statements in accounting reports, where all these discussed important details are disclosed. This is convention of disclosure. With this, we come to an end of all the accounting conventions and principles. My friend Peter is now well aware of what each of them means. Please like, comment, and subscribe for more such accounting lessons.